All right, guys, now we're going to talk about three key types of financial risk that companies face, all of which are connected to broader economic and market trends. First up, we're going to talk about interest rate risk. Picture this, you're running a business and you've taken out loans to expand your operations. Suddenly, the central bank decides to hike up interest rates to curb inflation. What happens? Well, your loan just got more expensive. Your interest payments increase, and that bites into your profits. This is why businesses need to be aware of interest rate risk. Changing interest rates can have a big effect on the bottom line. Next, we're going to talk about currency exchange risk. So imagine you're importing goods from overseas. You're paying a foreign currency, but your revenue is in your local currency. If your local currency weakens, you'll have to spend more to get the same amount of goods. This is what we call currency exchange risk, and it's particularly relevant for businesses that operate internationally. Currency values can fluctuate based on a range of economic factors, from changes in interest rates to political stability. And then finally, we're going to talk about price risk. So let's say your company invests in stocks or other assets, or maybe you're a manufacturer relying on certain commodities. If the prices of those assets or commodities fluctuate, it can affect your company's financial position. Perhaps the value of your investment falls, or your input costs rise. This is what we call price risk. And again, prices can change based on a whole host of economic and market factors, from shifts in supply and demand to inflation and technological changes. So the key takeaways that we're going to have from this is that these risks, interest rate risks, currency exchange risks, and price risks, they're not just abstract concepts. They're practical, real-world issues that businesses face every day, and they're all tied to larger economic and market trends. So understanding them is just going to help businesses navigate the unpredictable world of commerce. Okay, so let's delve into each of these one by one. Interest rate risk pertains to changes in the interest rate that can negatively affect the financial state of a company. So for example, a rise in interest rates can increase the cost of borrowing for a company with significant debt. For example, imagine you're running a bakery and you've taken out a loan to buy a new oven. If interest rates go up, your loan repayment could become more expensive. If your bakery profits don't increase at the same rate, you might have trouble paying back the loan. Okay, so how can we determine interest rate risk? There's a ratio called interest coverage ratio. So this is a key measure here. It's calculated as earnings before interest and taxes, aka EBIT, divided by interest expenses. A higher ratio indicates that a company is better positioned to meet its interest obligations, whereas a lower ratio indicates a higher risk of defaulting on interest payments. So the interest coverage ratio is essentially asking how many times over could we cover our loan repayments with the profits we're making. If the ratio is low, that means that the interest payments are a heavy burden. So let's say that Starry Night Coffee Co. has reported earnings before interest and taxes of $500,000 for the year. The company has an outstanding loan for its state-of-the-art coffee roasters on which it pays annual interest expenses of $100,000. What is Starry Night's interest coverage ratio, and what does it say about the company's ability to meet its obligations? So again, the interest coverage ratio is calculated as EBIT divided by interest expenses. So for Starry Night Coffee Co., the interest coverage ratio would be EBIT of $500,000 divided by interest expenses of $100,000, which would make its interest coverage ratio 5. Okay, so as a result of 5, this indicates that Starry Night is earning 5 times the amount it needs to cover its interest expenses. So generally, a higher interest coverage ratio is better as it signifies a lower risk of default on interest payments. So in this case, Starry Night appears well positioned to meet its interest obligations. Okay, so currency exchange risk refers to the potential losses from fluctuations in exchange rates, which can affect companies doing business internationally. So this risk comes into play if you're dealing with different currencies. So let's say that your bakery imports special flour from Italy, and you pay for it in euros. If your home currency, say the dollar, falls in value compared to the euro, then your flour becomes more expensive and your profit might decrease. Okay, so that's currency exchange risk. One way to quantify this risk is by looking at the percentage of revenue or the costs denominated in foreign currencies. A higher percentage indicates a higher risk. To measure this risk, you're going to look at how much of your costs or revenue is in foreign currency, right? So the more you rely on foreign currencies, the more you're exposed to this risk. So if we're taking a look at an example, Starry Night Coffee Co. is based in the US, and they purchase a special type of coffee bean from Colombia. They have agreed to pay 200 million Colombian pesos, or COP, for the next shipment in a year. Okay, so the current exchange rate is $1 per 3,800 COP. However, due to potential economic instability, Starry Night Coffee Co. fears that the US dollar may weaken in the next year to $1, which would then equal 3,500 COP. So how much more in US dollars might Starry Night Coffee Co. have to pay for the beans if this happens? So the first thing we got to do is calculate how much Starry Night Coffee Co. expects to pay with the current exchange rate. So if the current cost in US dollars equals the amount in COP divided by the current exchange rate, we're going to have to take 200 million COP, right? That's the amount that they agreed to pay in total, divided by 3,800 COP. The exchange rate is 3,800 COP to the US dollar. So 200 million divided by 3,800 gives us $52,632. So now let's calculate the cost and what it could be if the dollar weakens as they fear. So the cost in US dollar, if the dollar weakened, would equal the amount in COP, right, the 200 million, divided by the weakened exchange rate. So if we're worried that it's going to go down to 3,500 COP to the US dollar, then 200 million divided by 3,500 would equal $57,143. Okay, so the question's asking how much more in US dollars would they have to pay if this happened? So the additional cost equals the cost if the dollar weakens minus the current cost. So the cost if the dollar weakens would be $57,143 minus $52,632. So we're looking at $4,511. And again, that is the amount that they would have to pay additionally if this were to occur. Okay, and then finally we have price risk. And this pertains to the risk of a decline in the value of a security or a portfolio. This is the risk that something you own, like a stock or an ingredient in your bakery, could drop in value. For instance, let's say that you buy a lot of flour up front, thinking it's cheaper to buy in bulk. But then the price of flour drops significantly. Now you're stuck with this expensive flour while others are buying it cheaper. That's price risk. So we measure this risk with tools like beta and standard deviation. Beta measures the volatility of a security or portfolio compared to the market as a whole. So this is like a comparison to the market. If your flour price moves wildly compared to the average flour price, it has a high beta. So a beta greater than 1 indicates that the security or portfolio is more volatile than the market and therefore has a higher price risk. Whereas standard deviation measures the dispersion of a set of data from its mean. Right, this is a measure of how much your flour price jumps around. If it changes a lot, the standard deviation is high, meaning the price risk is high. So if the prices of a security have a high standard deviation, the price is considered to be volatile, which can mean more risk. So if Starry Night Coffee Co. holds a portfolio of stocks worth $500,000 as part of its investment strategy, the beta of their portfolio compared to the S&P 500 is 1.5. If the S&P 500 index decreases by 10%, then we want to know what is the expected decrease in the value of Starry Night Coffee Co.'s portfolio. So beta is a measure of a stock or portfolio's volatility in relation to the market, right? So a beta having 1.5 indicates that the portfolio is 50% more volatile than the market. Therefore, if the market decreased by 10%, we would expect the portfolio to decrease by 15%. Why? Because we're taking 10% and multiplying it by 1.5. So the expected decrease in the portfolio's value would be the decrease in value equals current value times expected decrease percentage. Okay, so if the current value is $500,000 and we multiply that by the new 15%, now we know that the decrease in value is $75,000. So if the S&P 500 index decreased by 10%, Starry Night Co. could expect its portfolio to decrease in total value by $75,000. This is the price risk associated with their stock portfolio.